Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this video tutorial of a product that we're very, very proud of. We call the Blue Collar Investor Elite Plus Calculator. Now, over the years, members of the BCI community have been using two main strategies: covered call writing and selling cash secured puts. Now, we have developed calculators for both of those strategies, multiple calculators, I might add. But many of our members have asked us, is it possible to create one spreadsheet that incorporates both strategies into the one tool? And yes, we have now created that product, again, the Elite Plus Calculator. This video tutorial will go through all of the entries and calculations that you will find in this product. Let me first give you an overview of the spreadsheet, and then we'll get into the specifics of each section. Right now, you're looking at the very top of the spreadsheet, and this is the covered call calculator on the top over here. So we have cells where you can add in multiple trades into the blue cells on the left. And then once those are entered, then the white cells on the right become populated, as well as the yellow cells. Now, towards the bottom of that section, we have an area where we're calculating our total portfolio statistics, something that we never had before in the individual calculators. Now, if we scroll down to the second section over here, we have our section for cash secured puts. So as you could see, we have the left side, which is very similar to that on the right side. Let me just clear this off here. We have the left side, which is very similar to the left side on the covered call writing. And then once again, once those cells are populated, we get our calculations automatically on the right side of the cash secured puts spreadsheet. And much like the covered call, at the bottom, we have our overall portfolio returns and positions. Now, we do have in both areas, we have in red highlighted that it's important to place your exit strategy buy to close limit orders after entering your trades. And once we do that, that will give us the protection if the trade starts to turn against us, or in some cases, if the trade turns out much better than anticipated. Now, the final section of the spreadsheet is at the very bottom here. You could see we were looking at multiple trade on the left tab, but we also have a What Now tab for rolling covered call trades, and we have an Unwind Now tab for unwinding covered call positions mid-contract. Now, those tabs were part of the basic Ellman calculator in the case of the What Now tab, and both of them were part of the Elite Ellman calculator when we included both the What Now and the Unwind Now tabs. So those are also included in this new tool that we created in 2020. So that kind of gives you an overview of the spreadsheet. So now let's go back to the top and really break this down. On the very top of the spreadsheet, now remember we're back into the covered call section, we put in the option month and year and the expiration date. Now once that information is in, as every calendar day passes, in this yellow cell here, we will get the number of days until contract expiration. So the contract expires on 8/21, and we're 27 days prior to that. Every day that passes, the number of days will decrease. And that becomes automatic once we fill in those two blue cells on the top left side. Now let's look at the entry data on the spreadsheet on the top left. Of course, we put in the stock symbol and industry. The reason we put in the industry is we want to make sure that we're not duplicating the same industry. We don't want to have too heavy a presence of stock or industry. And this is part of our diversification requirement. Then we put in the earnings report date because one of the golden rules of the BCI methodology is to never ever have an option in place that expires after an earnings report date. So if the ER date is prior to the contract expiration in that contract month, we will not use that particular option. Now, we also include ex-dividend date information for those of us where it's very important not to have the shares sold, perhaps for some tax issues, but that is the most common reason for early exercise is an ex-dividend date. So that's an important date if losing the shares is something that concerns us. Of course, we put in the price of the stock when we entered the trade, the value of the option that we sold, and the strike price of the option that we sold. Now, to keep track of our entire portfolio, we'll also enter the number of shares, and they'll always be in 100 share increments. And then finally, here we have the expiration date. As you see in this example here, they all expired on August 21st. Now, once that information is put into the blue cells, excuse me, put into the blue cells, then the white cells will then become populated with the calculations. So the time value column here for covered call writing is the actual premium that we generated for at the money and out of the money strikes, but for an in the money strike, the calculator will deduct the intrinsic value. So it's a time value return in a dollar amount. So for example, for AMD over here, the stock was trading at 55.04, and we sold the out of the money 57 for $1.50. So that $1.50 is all time value profit. Now, had we sold an in the money strike, like over here, for example, with DHI was trading at 63.48, and we sold the in the money 60 call for $5, well, we can't count that entire $5 as profit. We have to deduct the intrinsic value, $3.48. The amount the 60 strike is lower than current market value. From the $5, that's done by the calculator. We don't have to do that. And that will tell us that our time value return is $1.52. Now, in that same regard, intrinsic value applies only to in-the-money strikes. So for DHI, that particular strike is $3.48 in the money, and that's the intrinsic value component of the option premium. Now, upside potential relates to the amount that the share can appreciate over and above if it moves from current market value up to the strike price. So therefore, it applies only to out of the money strikes. So let me just clear away these arrows so it's a little bit easier to see. And we see here now, for example, let's go back to AMD at the top. With the stock trading at 55.04, if we sold a $57 call, we have an opportunity for another $1.96 per share. The price moves from 55.04 up to the 57 strike. Now, the yellow column in the middle of the spreadsheet now is the break even. Now, the formula for break even is always the same. It's the price of the stock when we enter the trade minus the entire premium. So that's always the same. Now, while we're at it, in case you are not sure of what each column heading represents, if you take the cursor and put the little cross there over the column title, it will explain what it is. So the user guide is part of the spreadsheet. You know, if you want to know what downside protection is, just move the cursor over here. So one of the nice advantages of this particular tool is that the user guide is incorporated right into the spreadsheet. Okay, so let's now go to our ROE, or return on our option, and that's the time value divided by the price of the stock. Now, had we sold an in-the-money strike, then it would be the time value divided by the strike price, because we use intrinsic value to buy down our cost basis. That's all explained in my books and DVDs, but you know, if you want to know what the actual what this means, what the formula means, If you just hover over it, it will give you the explanation. Now we're back to upside potential, which is the next row over here. And once again, that's the percentage amount that we can generate from our return if share price moves from current market value up to the strike price. So in that AMD example, the return on our option was 2.70%. And we could get an additional 3.6% if the price moves up to the strike price. So there's an opportunity for 6.3% 1 month return. Now, downside protection applies only to in-the-money strikes. So let me draw the arrow in the correct spot over here. And so at-the-money and out-of-the-money strikes have no downside protection. But in-the-money strikes do. So if we go back to that DHI example where the stock was trading at 63.48, we sold a 60 call for $5, the calculator will tell us that we have a downside protection of 5.5%. So what that means is DHI can drop by 5.5%, and we still will be guaranteed a time value profit of 2.5%. Stated another way, it can move from 63.48 to below the 60 strike, to up to but not below the 60 strike, and we still will have generate a 2.5% 1 month return. Now, our root premium is a time value premium per trade. So, for example, if we go back to, let's look for something that has multiple contracts over here. The $3 premium for the EDU trade, which had 300 shares, means that the total premium we received for the 300 shares is $900. That is then incorporated into our total premium return at the bottom, which we'll get to in just a moment. Upside potential in dollar amount is the same thing. How much more can we make in a total dollar amount if the price of the stock moves from current market value up to the strike price? Now, the total invested is the cost of all the shares. Now, had we sold an in-the-money strike, as we did with DHI over here with that 60 call, we will deduct the intrinsic value because it lowers our cost basis. And so that will give us the actual amount that we invested, and then the returns will be based on the time value return of that cost basis. Now, if we, let's clear that off, and we go back now to the last 3 rows on the spreadsheet that are highlighted in yellow, and this relates to our exit strategies. So the 20% and 10% guidelines relate to when to buy back the short call if the price of the stock declines. Once again, that's explained in detail in my books and DVDs. And some people like a guideline as to when to also sell the stock. Now remember, we first have to close the short call before we sell the stock. And some people like a guideline as to when to do that, and a reasonable guideline would be 7%. Now, if we look to the bottom of the top part of the spreadsheet, still covered calls, you will see in the first column total number of contracts, 15. Well, if we look over here and we count up the number of 100 increments we have, 1, 2, 4, 7, 12, 13, 15. So that's 15. Now, if we changed one of those, let's say 200 to 300, then that 15 will then become 16, as you see over here. Now, we also add up the total portfolio return, this column over here. And of course, we're not including intrinsic value. So that's time value only for all the contracts sold, 36.38 as it's right here. Now, upside potential relates to how much more we can make in total dollar amount for all the contracts sold, 13.42. So our total maximum return for the 1 month is 49.80. Now, the total invested, of course, minus intrinsic value, is 157,358. And that represents a a flat return without upside of 2.31%, with upside 3.16%. So you could see that my return goal range is 2 to 4%, and we certainly realize that with our initial trade structuring. So you could see here that gives us a lot of information that the old multiple tab of the Elite Calculator also gave, but then a lot more because it also gives total portfolio return. It gives us opportunities to put in industry information as well as exit strategy information on the right side of the spreadsheet. And of course, we have that notation to enter your buy to close limit orders after you enter the trade. Okay, folks, let's now scroll down to the selling cash secured puts section of this calculator. And the blue cells on the left side of the spreadsheet are the same as the blue cells for covered call writings. That didn't change. But what did change are some of the calculations. So now the time value return, since we only do out of the money cash secured puts in the BCI methodology, is your total premium that you're going to receive. We don't do in the money cash secured puts in the BCI methodology. So it's the total premium per share. Now we also give the total premium per contract, which is just the per share amount times 100. Now, as far as the cash required per contract, our broker will require us to put in cash equivalent to the strike price minus the put premium times 100 times the number of contracts. So this cell here will tell us per contract how much cash we have to put into the trade. And then the cash required per contract over here. So that information is important because that will dictate some of our calculations moving from the left to the right side of the spreadsheet. And the break even is going to be our strike price minus the put premium. And that's also important in terms of calculations moving forward. Now, the return on our option, the ROO, is going to be our premium divided by our break even, or the amount of cash the broker requires to put into our account. So let's go back to AMD, where the stock was trading at 55.04, and we sold the 50 out of the money strike for $1. Well, our broker is going to require us to put in 50 minus $1, or $4,900 per contract. A $1 premium on a $4,900 investment results in a 2.04% 1 month return. Remember, our premium is $1 times 100. And if the option is exercised and we buy the stock, in this case for 49, when it was trading at 55.04 when we entered the trade, that represents a 10.97% discount from when the stock was trading at the beginning of the option sale. So one of those two things is going to happen. We're going to generate a 2.04% 1 month return, or we're going to buy the stock at a discount of 10.97%. Now, if exercised, our cost basis is going to be the strike minus the put premium, 49. You'll notice that that column is the same as the break-even column. Now, once these cells are, we have all these calculations, then of course we take a look at the exit strategies. And those of you that read my book or listen to my put selling DVDs, you know we have a 3% guideline as to when to buy back the short put if share price declines 3% or more below the strike price. So that's information that will be given to you once you fill in the cells. It's right there, so you'll know exactly what price to look for. We also have 20%, 10% guidelines for puts, but that's in case the stock price accelerates, causing put value to decline. We may be able to close that put position and then use the cash to start a new one if the cost to close is very, very low. And if the stock price goes up pretty high, that's a strong possibility. So those three exit strategy thresholds will come up automatically once the left side of the spreadsheet is filled in. That brings us now to the bottom of the put calculator on this spreadsheet. And you could see the total number of contracts, 15, and the cash return flat, which is pretty much all we're getting, 2760, and the total invested, which is the put strike minus the put premium times 100 times the number of contracts, 67,330 in this case. And that will result in a percent return of 4.10%. And that's how the initial trades were structured for the entire portfolio. And we make a note, just like on top, to place your buy to close limit orders. So that will happen automatically if those limit orders if those thresholds are reached. And once again, just as a reminder, the very bottom part of the spreadsheets, we've brought over from the Elite Element Calculator, the What Now tab and the Unwind Now tab for covered call writing exit strategy. So that's included in this spreadsheet as well. So let's scroll now back up to the top of the spreadsheet, and you can see here that we have our name. It's the Blue Collar Investor Elite Plus Calculator. The BCI team is very, very proud of having developed this tool. It was really based on what you, our members, have told us over the years, that you want the convenience of one spreadsheet for both strategies. And by adding in the total portfolio calculations, as well as incorporating the user guide right into the spreadsheet, plus all the additional information that we can put into this, I believe it's one of the most valuable products offered in the BCI community. So that's pretty much it. I hope, ladies and gentlemen, that you enjoyed my explanation of this new spreadsheet. And for those of you who decide that it works well within your trading strategy, I hope that you not only enjoy it, but I hope you benefit from it financially. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.